Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we have a topic in front of us that is double taxation. What exactly double taxation is all about? Let's try and understand this. See, as there's a dialog box over here, it shows some information. It says that when we pay income tax twice on the same source of earned income, or the assets or the financial transactions, then the taxation principle is known as the double taxation principle, which is known as double taxation. So this taxation principles may be applied at both at the corporate level as well as at the personal level also. Again, when there is an international trade, then this taxation is applied in two different countries. Like for example, corporate profits when earned are taxed as corporate tax and then taxed again as the so-called personal income. So when it is distributed as dividend among the stockholders, and also in case of the owner of the organization who is also the employee of the organization, so they get taxed when he receives the salary. So again, if he receives the dividend from the company, being a shareholder, he needs to pay the tax on the personal taxes. Let's discuss the double taxation in corporation S Corp and C Corp, two corporations. The principle of taxation, it affects the C Corp corporations where the business profits are taxed both at the corporate level and the personal level. And double taxation in corporation must pay income tax at a corporate level, or at the corporate rate, even before distributing the profit to the shareholders. So then the profit shared between the shareholders as the dividend is taxed again at the recipient's individual rate. Thus, the corporate profits are taxed twice. So the double taxation in the corporation is not affected by the taxation principle. And a corporation which passes through the earning directly to the shareholder without going via the intermediate step of paying the dividends. Fourth, it is generally accepted, as a negative element of the tax system, and the tax authorities, they try and avoid it in the possible situation. So the taxation process, they puts the corporation at the disadvantage when compared to the unincorporated businesses. So that provides the incentive to corporations to use debt financing instead of equity financing, and then and retain earnings instead of distributing among the shareholders. Moreover, if corporates and personal tax systems, if they are integrated, then their tax code is simplified to to a large extent, you can say that. Now the tax results when the divided when the dividend is given, how the things are going to get affected. See, the corporate level tax for the S corp, the taxable income is zero, but for C corp it's 2 million. So the marginal tax rate, that's the maximum marginal, is going to be 28%. Since it is zero, there'll be no tax that will be charged. But over here on 2 million, 28% is going to be 5,60,000. At the individual level, it's going to be the S corp, the company who's going to get charged. So 2 million into 35%, which is the marginal rate for S corp, and the tax is going to be 7 lakh. But over here it's going to be zero, and the qualified dividend tax 15%, zero in this case, but again 15% will be charged to C corp. So how to avoid this kind of double taxation? See, there are several ways for how to avoid the double taxation. First, the smaller double taxation in corporations, most of the major shareholders are you can say employees of the firm, and thus the earnings are distributed among the shareholders as so-called wages, fringe benefits. So for how to avoid the double taxation, see, although the employee is liable to pay tax on their income, the corporate deducts the wage and the benefits paid as an expense of the company, and thus they avoid paying corporate taxes on the amount. Second, in case of the small business, the entire amount is distributed to the employees or the owner's account, and thus nothing is left which can be subjected to the corporate tax, right? And in situations when income is left with the business, it is done so for financing future growth of the company. Though this amounts come under the corporate tax, these taxes are usually lower than the rate paid by individuals. Fourth, there are large companies whose shareholders are not their employees, and the earnings or corporate profits cannot be distributed as wage or fringe benefits, are often able to avoid double taxation. So these employees can be shown as the tax consultant, and as the payment to the consultant come under the tax deductible business expense and dividend and another dividend. So the shareholders in this situation still pay tax on the compensation. Six, it is also an option to add the shareholders to the payroll, as a member of the BOD, that's the board of director of the company. So there are some tax exempts, for the investors, such as like, pension funds and charities, which are significant, they are shareholders in the large corporations. So these groups have the tax exempt status, which helps them to avoid paying taxes on their corporate dividends received. Now, what about the international double taxation? See, international business, if you see, they often face the issue of the taxation principle. Now, their income gets taxed in the country where it is earned, right? And then this income is again taxed when it is sent back to the business home country. So in many cases, the total tax rate becomes so high, making pursuing international business as an impossible and expensive venture. So to avoid this kind of situations, countries all over the world have made hundreds of double taxation treaties, just to avoid the double taxation, which is based on the model given by the OECD, which is your Organization for Economic Corporations and Development. So, mentioned in the Double Taxation Treaty by the signatory nations, they are the limit of the taxation of the international business to help in trade between the two countries to avoid double taxation. So, Indian position. What is exactly the India's position on the double taxation? See, India has comprehensive DTAA, that is the Double Taxation Avoidance Agreement, with closely with 88 countries, and of which 85 have already been put into action. So there are provisions in the Income Tax Act which provides relief to the taxpayers, and it helps to avoid double taxation. So let us suppose that the interest on the NRI bank deposits attracts, let's say, 30%, right? So TDS in India. So since India has signatory double taxation treaty with 88 countries, so tax deducted may be 10 to 15% instead of 30%. Again, many foreign institutional investors who trade in Indian stock market, they are operating from Singapore to Mauritius. India has a signatory double taxation treaty with the Mauritius, following which the capital gains from the sale of the shares are taxable in the country of the residence only of the shareholder, and not in the country of the residence of the company whose shares have actually been sold. So, company residing in Mauritius selling shares of the Indian company, they need not pay tax in India. And since there is no capital gains tax in Mauritius, the company avoids paying any other altogether. So, moreover, on a concluding end, in the large countries like India, where the product is transferred from one state to another, it is used to get taxed in various states, and this that they get rid of this problem of the government in India has introduced a thing called GST. So that's it for double taxation. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.